Hey everyone, welcome back to Corporate Decoder, the place where we untangle the messy world of corporate filings, and today we're diving into Pelican Acquisition Corporation's latest report, which is a bit of a treasure hunt for what this company is actually up to. This report is like a snapshot of Pelican Acquisition Corporation's financial health towards the end of October 2025. It is essentially a checkup for a company that is still figuring out its main mission, which is to find another company to merge with. Think of them as a matchmaker, but for businesses, and they've got a deadline to make that match. We'll be looking at where their money is, where it is going, and what risks they're facing as they try to make that big business combination happen. Before we jump in, if you like getting the real story behind these financial documents without all the corporate jargon, make sure you are subscribed to the channel and for even more exclusive insights and to join the conversation. Check out our Discord community. The link is in the description below. First off, an important detail. Pelican confirms they've been keeping up with their filing requirements. This is standard for any company, but for a SPAC like Pelican, it is a sign they are actively participating in the regulatory system. Let's get right to the heart of things, the financial statements. This is where we see the actual numbers that tell the story of the company's financial standing. Looking at the balance sheet, we see their assets and liabilities for the 31st of October, 2025. Their total assets are a hefty $88,054,474. A huge chunk of that $87,774,470 is tied up in their trust account. This is basically money they've raised from investors, sitting there waiting to be used for a business combination. It's pretty much their core asset, the firepower they have to make a deal. On the flip side, their total liabilities are pretty small, $311,250. This is good news because it means they don't owe a lot of money right now. Now this shows us how many ordinary shares are subject to possible redemption. On the 31st of October 2025, they had 8,625,000 shares that investors could potentially redeem. The value of these shares at redemption is noted as $87,774,470. This is a critical number for a SPAC, as it represents the money that might go back to investors if a deal doesn't happen. Moving on to the statement of operations, this is where we see their income and expenses. For the 3 months ended the 31st of October 2025, Pelican reported a net income of $514,636. This sounds great, right? But digging deeper, this income comes mostly from interest earned on the money in their trust account. Their actual operating expenses, like general and administrative costs, were $375,265. So while they made money, it wasn't from running a business yet, it was from the interest on their investment funds. For the 9 months ended the 31st of October 2025, they reported a net income of $802,493. Again, this is largely driven by interest income of $1,524,470. Their administrative expenses for this period were $726,449. So the pattern holds. The company is earning money from its investments, not from operations. Now let's look at the cash flow statement. This shows how cash moved in and out of the company for the 9 months ended the 31st of October. 2025, they used $827,919 in operating activities. This might seem like a lot, but it's typical for a SPAC that's spending money on setting up operations and due diligence before a merger. They also invested $86,250,000 in their trust account. This is the money they received from investors going into that big trust fund. On the financing side, for the 9 months ended the 31st of October 2025, they had substantial activities. They received $86,250,000 from the sale of public units, and another $2,987,500 from private placement units. This confirms they raised significant capital through their initial public offering, which is exactly what a SPAC is designed to do. Diving into the notes, we learn that Pelican was formed in July 2024. They are a blank check company, meaning their main purpose is to find and merge with another business. They haven't started any real operations yet. Their big moment was their initial public offering, or IPO, where they sold units. The IPO was declared effective in May 2025. They sold about 7.5 million units at $10 each, plus some additional units to cover over allotments. That is a lot of money raised, over $86 million in total from the public offering and private placements. This money, as we saw, is mostly sitting in a trust account. And sure enough, $86,250,000 of those proceeds went straight into their trust account. This is the war chest they have to find a business to merge with. They have a deadline, by the way, until August 2026 to make this happen. If they don't, the money generally goes back to the investors. Now here is the big news. On the 9th of September 2025, Pelican signed a merger agreement. This means they found a potential target for their business combination. The deal involves entities called Pelican Holdco, Greenland Exploration Limited, and March GL Company. They plan to merge with these entities. And the combined company will be renamed Greenland Energy Company and trade on the Nasdaq. This is a crucial step, moving them from just a shell company with money to a company aiming to operate a real business. The deal values the combined company at $215 million. Pelican shareholders will get shares in the new company based on their current holdings, and the existing shareholders of Greenland and March DL will also get shares. This is where Pelican's money from the IPO will be used to help form this new, larger entity. Under commitments and contingencies, we see the various risks and uncertainties the company is facing. They mention global conflicts and economic uncertainties that could impact their ability to complete the merger or the operations of the target business. This is pretty standard language, but it highlights that even with a deal in place, a lot can still go wrong. This section is super important for understanding their immediate financial health. It states that as of the 31st of October 2025, the company had very little cash, just $220, and a working capital deficit. They are in a race against time to complete their business combination by August 2026. The report explicitly says there is substantial doubt about the company's ability to continue as a going concern. This is a serious red flag, meaning that if they don't complete the merger, they might not be able to keep operating. Here, they discuss how they value their financial assets. Most importantly, their investments held in the trust account are valued at $87,774,470 using the level 1 input, which means they're valued based on quoted prices in active markets. This confirms the value of the funds they have set aside. And now for what happened after the reporting period on the 24th of November 2025, Pelican Holdco issued a promissory note for $200,000 to Greenland. This shows they are continuing to fund aspects of the deal even after the report's end date, which is typical for companies in the midst of a merger. In their management discussion, they reiterate that they haven't generated any operating revenue. Their focus remains on the initial business combination. They acknowledge the significant costs of becoming a public company and the expenses related to finding and completing a business combination. They clearly state their strategy for funding the business combination, which relies heavily on the IPO proceeds and potential future financing. Finally, they mention they are an emerging growth company and are taking advantage of certain relaxed reporting requirements. This is common for newer public companies and allows them to focus resources on their core business rather than extensive compliance. So, what is the big picture here for Pelican Acquisition Corporation? On one hand, they've successfully raised a significant amount of capital and have identified a target for their business combination. This is a major step forward and shows progress towards their goal. The market value of the proposed deal at $215 million suggests a potentially substantial company they are aiming to become. However, the going concern warning is a stark reminder of the inherent risks in SPACs. They are essentially living on borrowed time until the merger is complete. Their financial health is directly tied to the success of this upcoming deal. There is no operational revenue yet, meaning their entire existence hinges on this one. Major transaction. The biggest risk is that the deal falls through, which could lead to liquidation. On the flip side, if the merger with Greenland Energy Company is successful, they could be on the path to becoming a publicly traded energy company. What is your take on Pelican's situation? Do you think they'll pull off this merger? Let me know your thoughts down in the comments. If you found this breakdown helpful, please smash that like button. And don't forget to subscribe for more in-depth looks at corporate filings. And for deeper dives and to connect with other finance enthusiasts, join our Discord community. The link is in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.